So the U.S. government and the Federal Reserve are currently teaming up to bail out the banking system. Yeah, you heard me, a bailout. This is like a Marvel movie where the Treasury Department and the Federal Reserve, and President Biden and Jerome Powell and Janet Yellen are trying to save the whole world by saving the banking industry. Now, the rule is that any money up to $250,000 in the bank is insured by the FDIC, the insurance that we have for these lending institutions. However, the protection is now limitless, and technically it is there as a lending facility where banks can pledge their assets for liquidity. Now, ultimately, this is a special treatment for the banks, which is a privilege and protection for the people and entities who have over $250,000, which is not most of us normal, common people. Now, the politicians, the Federal Reserve, they can't let their private equity firms lose a lot of money. You know, these are their friends, their donors, and they need to be made whole. Now, therefore, this is a bailout. Taxpayers will foot the bill with more inflation. Now, the banking contagion is now over, and the government and the Federal Reserve, they're backstopping these banks. Now, there's no more threat of a run on any of these banks. Now, the media is saying that the financial system's broke, and it means that the Federal Reserve will not raise interest rates on March 22nd when they meet again. However, this decision is not based on what happened Thursday or Friday or even over the weekend. What happened just a few days ago is really just an inconvenience to the Federal Reserve. But you know that this is not going to be enough to move that needle, and we need that needle to move. Now, the expectation was that the Federal Reserve would raise those interest rates by about 0.5% on March 22nd when they meet. But, however, after this Silicon Valley Bank incident and the bank bailout, like I just said, the chance of a 0.5% interest rate increase has fallen to 0%. Now, the current odds are 24% chance of no interest rate increase on March 22nd and a 76% chance of a 0.25% increase. Now, in my opinion, the Federal Reserve is going to go with the 0.25% increase on the March 22nd. They cannot afford to pause right now with CPI inflation above 6%. Their decision is going to be based off of inflationary reports. Ultimately, it boils down to inflation reports. Now, whether it's going to be the CPI or the PC, the Fed says it's probably going to prefer to look at the PC inflation, but they still reference headline CPI inflation as well. Now, they cite core CPI inflation a lot when they're talking about this stuff. Now, tomorrow's report is going to be a final piece of the puzzle, and it's going to be the last clue of what the Fed's decision is going to be on March 22nd. Now, the banking industry is just a sideshow, and it's too early for the Federal Reserve to hit the pause or hit the brakes because inflation needs to decrease further, and they need to see more progress. So the 24% odds, that's way too high for a pause right now. You know, the question is, how much more progress does the Fed need to see? Now, the February CPI inflation report, this is a big deal. Now, service inflation is still running hot, like we said before in another video, as evidenced in the February jobs report, like we talked about. Now, January was revised down. February came in hot because expectations were 225,000 new jobs, but we had 311,000 jobs added. Now, the bottom line is inflation needs to come down, Fed needs to pause it, and they're going to raise interest rates by 0.25%.